Good day. My name is Professor Anthony Revicchio. I am the founder of the Financial Advisors Group, a money management firm, and the CEO of Revicchio Online Tax Advisors. Welcome to our income tax video cast. Grab a pen, grab a piece of paper. We're going to be talking about income tax planning for real estate. So, let me also reference that I have notes in front of me that I'll be referring to every now and then. And as you can see, I'm celebrating Veterans Week as this is being video cast at that time. Let's talk about real estate, ladies and gentlemen. Now, when we talk about real estate, right, what we have to remember is we're talking about a simple subject. We're talking about homeowners and we're talking about investors. And what do they want when we talk about taxes and talk about real estate? We're talking about the same strategy. We're talking about trying to lower your income tax liability, right? And there's going to be several strategies that are involved. Now, I'm going to try to take a 2-hour class lecture. As some of you know, I'm an income tax professor for both public and private universities. I'm going to try to take a 2-hour lecture and condense it into 10 minutes. So feel free to, again, grab a pen and take notes. So when we talk about trying to lower your tax burden, right, and real estate, there's a variety of different strategies. Let's talk about 4. The first one, very important, really nothing to do, just to remember. When we're a homeowner and we're talking about being able to write off your mortgage interest, there's something that we have to remember. Only $750,000 of that mortgage is technically tax eligible for deductibility. Now, your mortgage might be lower than $750,000, and all I'll say from an income tax standpoint is congratulations. But please note, if it's over $750,000, then no matter about the original $750,000, which is tax deductible, the rest will not be. Are there ways to get that eligible? Absolutely. That's an advanced conversation because, as with most Americans, but not all Americans, they don't have to worry about that threshold. Strategy number 2. You're a homeowner that rents property, right? Maybe you rent to someone that's paying you rent. And as you're receiving that rent, you have to declare that as income, right? And yes, that's bad, and yes, that's good, right? It's bad because you have to declare it as income, right? When we think of income in the income tax world, obviously most think of their work income, right? But there are technically 25 forms of income, and I won't go there except to say that rental income is one of them. So, of course, you're going to be taxed at your tax bracket. However, right, we want to be sure that we take advantage of our rental expenses, right? And that is very important because when it comes to your rental income versus your rental expenses, if there's still a profit afterwards, which is wonderful, you'll be paying taxes on that profit. So again, if you receive, I'm making this up as I go along, $10,000 in rental income, and then of course what's important is that you know what the maximization of your tax eligible deductions and credits, right? Let's say the total of that is $8,000, just for sake of argument, right? Well, that means you have made a profit of $2,000 with having someone in your home, right? That's wonderful. Now you get taxed on that $2,000, and that $2,000 is based on your tax bracket. What I mean by your tax bracket is you look at your federal tax bracket, your city and state tax bracket, your Social Security, all the way down the road. It can come out to about an average of 30 to 40% a year, as I'm sure you know when you look at your checks. So let's go to the expense part of the ledger. Well, there are several areas, and again, I'm going to try to condense this, but I'm going to give you a few that you should start writing. So the first one, right? Any promotion or advertising fees. You had a home, you might have promoted that you were looking for a tenant, right? You also have to manage that tenant, right? So there are appropriated fees that go into that area. Second is home insurance. Home insurance under this classification is 100% tax deductible. Number 3, Repairs, right? Let's not forget repairs in the home. Those areas are also tax deductible in this area. Maintenance, right? Well, we have to take care of maintenance costs, and of course, those are tax deductible. Supplies and equipment, I like to put them together, both of them, although the IRS treats it separately, but for this conversation, we're going to put it together. Those areas are also tax deductible. And probably the most important thing is depreciation, right? You have a home, it depreciates, it doesn't look that way forever. I wish it did, but it doesn't. And as it depreciates, you're allowed to write that off. So when it comes to rental property in this conversation, that area is very important. I hope that was something that was able to help you, but we're going to now go to another area. So let's talk about what I call a tax deferred strategy, right? You want to sell your home, or you're going to sell real estate, you're going to sell property. And you're going to make a capital gain, right? That's a profit. Well, how can I defer that, right? To pay it, you still have to pay it, right? There's no magic wand, right? And if there is, you can call me after hours, bad joke. But how do I defer that for another year, right? Another year for all types of income tax reasons. Maybe you'll be in a lower tax bracket next year, right? How do I defer that? Well, that's called a 1031 exchange, which is a little bit technical. I would ask you to talk to both income tax advisor as well as a real estate advisor. It's more paperwork than anything else. So instead of you giving somebody money or giving somebody a check, what you're doing, think of it very similar to like a direct IRA. You're signing a whole bunch of paperwork and basically, selling it that way. And the transference is taking place without you getting cash. That's the most important thing. Right? That's called the 1031 exchange. So again, because it's a whole bunch of paperwork related, you want to make sure you have the correct paperwork from both providers. So again, I would strongly recommend speaking to an income tax and real estate professional in a 1031 exchange in that area. If you're selling a home, you're going to pay a capital gain, but you want to defer that for a future year. Last strategy, financial management. You're an ad hoc landlord. Congratulations. Make sure you keep the paperwork as well as the income separate from yours, right? Very, 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 very important. The last little tip, if I might. This wasn't part of my strategy, but I remembered it as I was talking. You're renting out property, right? You might have a whole bunch of expenses, and of course you're going to have income that relates to those expenses. What should you have, in my opinion? A lease. Right? Go to the stationery store. Make sure you go somewhere where you sit down with the tenant, you come up with your terms and conditions, whatever those are, and you have a signed lease. You want that for a variety of different reasons, right? Not just for legal purposes, of course for IRS purposes. The IRS can ask you if you have a lease. Does it disqualify you? No. But as a guy that's got some of this gray hair going on, I would strongly recommend you have it. So consider that an extra little tip. Ladies and gentlemen, it was wonderful talking to you. Happy Veterans Weekend. Thank a veteran. And be tax smart. If you need any help, feel free to give me a call. 347-575-5045. Have a great day.